Okay, let's see if you've got what it takes. What I'm trying to do is to show you that you should be leaving the trading world behind, which is where we're listening to a lot of background noise about what's going to happen in the markets. Gold is going here, the stock market's going there, and something else is going to hell in a handbasket. So we want to be able to ignore all of that and just act on what we see in a perfectly objective manner, because the truth is that in the trading and investing process, you are the weakest link, as am I. So let's take a look. First of all, we're going to use some moving averages as a simple way of getting in and out of trades, and this is all fully explained in the book. You don't, all I want you to look at right now is, do I actually see that stuff? Do I see a green line, a blue line, and a red line? If you can see where the blue line is above the green line, then in one of our definitions of trend, we are now in an uptrend. And if we now then look to our trigger, and that's price or red line crossing above the blue line, and then we are now into that trade. That trade then continues on until our trailing stop stops us out at a pushback on the price somewhere down the road. And this is all detailed for you in the book. And you can actually, if you look to the left, you can see as Apple is bottoming out how the blue line is below the green as it's finishing off a downtrend. So the next question is, okay, you've got an idea that you can do it. So now let's take a look at why you should. Okay, let's hang on to that why you should. I want to tell you a little personal story, so I hope you're sitting comfortably. No, don't bother. It's just a quick story. I started in the industry as a financial planner, and so I took care of the insurance stuff, the tax stuff, the estate stuff, all of that kind of stuff, and the hands-on money management I left to the professionals. And in the year 2000 to 2002, I stood by helplessly and frustrated as I watched my clients take a beating in their accounts. And I took this up with the professional money managers as to why that occurred, and they gave me all kinds of platitudes, and ultimately they told me that it was up to me to move things around. Well, that was not my area of expertise by a long shot, and I had expected them to protect the holdings, and for assorted reasons, and I won't go into those now because they're just aggravating. But so what I decided at that point was, okay, if it's my responsibility, then I will take care of it. And I began to embark on a learning curve and gather in the designations I needed to be a hands-on portfolio manager for my clients, which is what I did. Now, 2 years 2 years went by, and I decided to revisit the scene of the crime and see, okay, I berated these guys quite severely as they entered my office, and now I wanted to see, okay, could I have done any better? Now, what you see to the left of this chart is the year 2000 when this stuff happened, and I'm looking at it, and where you see the vertical line, that's the one on the left side of this chart. You can see that there's a high in price, so a new high in price, and then you look below, and the energy that drives the market has not made a new high. Now, by that time, I had recognized and been taught that divergence between the energy that drives the price and the price indicates that trouble could be coming our way. Now, it doesn't have to come our way, but it is a good chance it will be coming our way. So you put a trend line, or you tighten your stops, or whatever it is you're doing, and then in this case, I put a trend line on just for this exercise, and when that trend line is crossed, then you're out, or you're short, or you're something else. You're certainly not long a market that has been told by a leading indicator that there's a problem coming, and then the problem presents itself, or the beginning of itself, and you just hang in there. So I was now confident that I would have made a different choice. Well, time goes by and we get to 2007, 2008, and lo and behold, we've got another high in the market and we don't have a new high in the energy that drives that market. Only now it's me in charge, and I took every client to 100% cash. And during the train wreck that followed, my clients did not lose a single dime on that in that stock market. So that is that justified everything. And this is what I'm saying to you. Could you see that? Can you see that? Could you see that there's a new high in the price of this market, but there's not a new high in the energy that drives it? And would you say, okay, that's a warning. I'm going to I'm going to do I'm going to follow the same steps. I'm going to put a trend line on there, and when that trend line is crossed, and that trend line is the thing that looks like an arrow sloping upwards, then when that is crossed, I am getting out. Can you do that? Yes, you can do that. Now, what we've got now is the years that follow. We've got a market that's been boosted by for unnatural reasons, and stimulated and eased and whatever you want to call it, till we've got that same thing occurring. We've got a high in the stock market and we don't have a new high in the energy that drives it. You can see a long sloping line down, and you can see a sloping line up. Now, what I'm going to do on the next slide is no, we're not going to get to your reasons why you should be doing this just yet. I'm going to take that little section, I'm going to expand it for you. So just stay where you are and I will get right there. Okay, look at me, like I'm at one with technology. Okay, you can see now that I've switched from what's called a monthly chart, which is a situation where each little candle has got a month's worth of information, to a daily chart where each candle's got a day's worth of information. And so the decision I was just talking about is really based on the longer term, which would be a weekly or a monthly chart. But in this case, let's look at the daily, and you could see a red up arrow on the price, and you can see a slightly sloping down arrow on the rate of change, or the ROC. Now that tells us that some bad thing is coming, and we don't necessarily take action right away, but what we do is prepare. So we can tighten our stops, we can make our positions smaller, or as in what my standard procedure is, to put a trend line on the price, and if that trend line is crossed, I am out. And you can see that occurred. You can see the vertical line where the new high in price, and where there's no new high in the ROC. Then you can see my trend line, and you can see the price crossing that trend line, and I would be out of that market. And look what we sidestep as we do that. That is the most severe fall since the 1800s. Now, some people would argue there have been bigger falls. I'm talking about the amount of points covered in the amount of time. That combination has not been seen since the late 1800s, or maybe 4 times or something. But anyway, it's an oddity. It's a warning. It's whatever you want to call it, when the market collapses that significantly in that short a time. Okay, so look, there's a way more information on the ROC, and what I've decided to do is the first 500 people that go to my landing page and buy my book, I will be sending them a detailed explanation of how the divergence, the ROC, how you can measure the downside, and so on. Much fuller explanation of this than you're receiving here. First 500 will receive those few pages describing the ROC and how we can make good, simple use of it. That, like, if you could see it right now, I'm confident. So let us now get to the reason why you should, now that we know that you could indeed do this. Okay, you're looking at a graphic of the efficient frontier, which is basically the risk reward of different portfolio structures. The horizontal axis is risk, increasing from left to right, and the vertical axis on the left is return, increasing from bottom to top. What you have for your first portfolio we're going to look at is 100% bonds, and you can see the risk reward of holding that. And you may be one of those people holding 100% bonds, money market, whatever, and you think that you are risk-free, and you need to accept there's no such thing as a risk-free investment. There's always some risk element to it, and if you look to the next portfolio combination, you can see that I have taken 25% of your bonds and I've exchanged those for stocks. And what I've done for you is I have lowered the risk profile of your portfolio, of your stock and bond portfolio, and you can see that because the portfolio has moved to the left, which is lower risk. And what's more, incredibly, I've improved your return. As you can see that the portfolio has moved up on the left-hand scale, meaning you've got a better return. And this is a counterintuitive thing for you, and I understand it because many of you have it, and that is you've just taken a risk-free investment. You've added what I believed to be a risk-free investment, and you've added a risky asset class to it, and you've made my portfolio less risky. And this is quite simply two risk forces being offset. The one in the bonds is being offset by the positive aspect of the stocks, and the riskier part of the stocks is being offset by the safer aspect of the bonds. That's why when you've got the two together, you have a safer and better returning portfolio. And so if this sort of thing, so you could, and when I'm saying you're going to look after your stocks, I'm not talking about in a riverboat gambler kind of way. I'm talking about using a simple method. I'm talking about maybe making half a dozen trades per month in a consistent way where you control your exposure, you control your risk, all of these things, and you will find yourself with a lower risk, better returning portfolio. If any of this is resonating with you, if you're seeing what I'm saying to you, then this may very well be a good road for you. And you should click the Learn More button and learn more. There's more for you to see, and hopefully you will join us as we leave the trading world and head into the world of trades. And thank you very much for stopping by. Okay, a little add-on for you. My email address you can see on the screen. If you've got any questions at all about what I've said, feel free to drop me a line. I'd be very happy to answer you. And I'll tell you what I'm going to do. You don't need to buy anything. I think that rate of change information is so important. If you just drop me a line and in the subject line of the email put rate of change or ROC, I will send you those pages whether you buy or not. Just drop me a line at the email address shown there, and I will send you those pages. I think you can make good use of them with any stocks you may have or any commodities. That divergence is quite a powerful thing. And as well, you've got my blog address that you can watch the trades unfold. I put down quite often the price ahead of time that we're going to get in, price we're going to get out, and as I said ahead of time, usually for you doubting Thomases, so that you can see as the trading exercise continues on from the book onto the blog, and will continue to the end of 2020. Okay, that's about it from me. I think this has been maybe a bit too long Not sure, but there's a lot of information. There's a lot more to go. So please click the Learn More button and get going to learn more. And hopefully I'll see you in the near future. In the meantime, take care of yourselves, and thank you for your attention. Bye now.